Hey, look, thanks. Thanks for making some time to hear us today. I thought I'd start off with a quick little introduction, and I'll let Emma explain what we do at the Global Value Fund and at Staude Capital. And then after that, I prepared some slides that I thought would be interesting to share to talk about, which is what I believe is going to be the most important topic for finance and for investing for the next couple of years, and that is inflation and interest rates. But I'll get onto that a little bit later. But just to start off, so I'm Miles Staude. I'm the portfolio manager for the Global Value Fund here in Australia. With me is the lovely Emma Davidson. She is the head of corporate affairs for GVF, Global Value Fund, and also runs the management company in London. She's also a terrifically lucky lady because she's lucky enough to be my wife. So it's a 2-for-1 deal with the Global Value Fund. And I guess to sort of talk about us a little bit. So first thing to say is we're a London-based firm. So I grew up in Australia, but I've lived in London for the last 20 odd years. And we've got a big team in there investing around the world. And the second thing to say is we're a bit different. So when we're not stock pickers, I imagine a lot of the guys that get up here and talk to you, and I heard you all having really interesting conversations earlier, was about picking interesting companies, undervalued companies or growth companies. We come at markets in a slightly different way. Instead of trying to outperform markets by picking stocks or bonds, what we try and do is find ways to effectively invest into the market at a discount. So what we do from London is hunt out asset plays all around the world, trying to buy assets that are trading below book value, or for lack of a better phrase, below breakup value. We invest into these situations, and then how we outperform is we've got a big toolkit of how to unlock the value in the things that we invest into. So it's an important philosophical difference, I think. We're not stock pickers, we think of ourselves more as asset traders. In doing what we do, rather uniquely, what we try and deliver is two sources of investment return. You get the return from the assets that we bought really cheaply. Hopefully that goes up through time. But then you get this second source of return, which is by far the most important part of the return for us, and that's us actively unlocking the value from these situations. And if that works together, those two sources of return compound, which is quite nice, and it generates what we think is quite an interesting proposition. Finding discounted asset plays, finding things trading for below breakup value around the world is actually quite easy. There's lots of these things out there. The special sauce, what we do as a team, is really an ability to unlock the value in them. And just really quickly, there's two ways we go about doing that. The first way is a really interesting trading business that we run. We've run for about 15 years now. And in the sorts of things we specialise in, there's these wonderful little arbitrages that we find in the market where you can literally buy $1 for 90 cents and you can arbitrage out in a few months' time. It's been a wonderful place to put capital to work. It's a key part of our intellectual property, so we're a bit secretive about it. And it also, it's not very scalable, so we can never put lots of money into these little opportunities we find. But that's fine for us, and it's one of the reasons we've always said we're going to stay relatively small. The second side of the business is the side that generally gets people's attention the most and certainly gets the most sort of glamour, and that's shareholder activism. So finding situations where you're buying things well below book value, well below breakup value. Typically something's gone wrong then. There's a failure in corporate strategy or failure in corporate governance. We'll come in, pretty thick skin, engage with boards, managers, other stakeholders, and try, like in a productive way, to try and solve the problem at hand. We've been doing this for a long time now, and we've got a pretty good track record and a very high strike rate of coming into these situations and unlocking value for everyone, and generally being able to do that behind the scenes in a sort of productive way. That's not always the case, and we certainly have our fair share of the gory stories where we have to go into situations and remove directors and be a bit nastier. But that's always the last thing we do. We don't never set out to do that. And when we're being a bit more aggressive, that's generally when there's vested interests at work. When we find boards or management teams working for themselves and not for investors, we can get quite religious about it all. And then I guess the last thing to say, for the Global Value Fund, that's a LIC listed here in Australia, what we set out to do with it, the aim is really to generate equity-like returns over time. So, high double-digit kind of return numbers, high single-digit, low double-digit return numbers, but on a much lower risk profile than you get from investing into the share market. And I'll let Emma talk about the numbers a little bit before I come back.
Okay.
Sorry.
Thanks, Miles, and thank you, everyone. Thank you for inviting us back. I have to say that Toowoomba and Broadbeach are my two favourite locations that we go to, and I keep selling Queensland as the destination that we should settle in, but I married a New South Wales boy, so it's a bit awkward.
You're going to fight the grandparents.
Exactly. Okay, so I'll just speak a little bit of, I'm not going to spend long, but I'll spend a little bit of time just talking about the Global Value Fund on the ASX GVF. We had a really good FY 2021, and we've started FY 2022 off well. For the 8 months to the end of February, we're up 7.5%, and that's versus the MSCI All Country World Index, which is up 1%. Now, our annualized returns from our IPO in 2014 through to the end of February have run at 11.1% per annum, and that's after all fees and costs. Now, a lot of you may know about GVF, but for those that are new, I thought I might just slightly recap what it is that we do and how we work. Miles did go into some of the detail, but I just wanted to show some graphical explanations of that. Miles mentioned we have this differentiated strategy. You know, our core skill set is an ability to go around the world and find discounted assets, and then unlock those discounts, whether it's through corporate actions that exist within the legal documentation, or indeed, a much more obvious example, shareholder activism. Our stated aim, as Miles said, is to target global equity market-like returns, but to do so with a much lower risk profile. And essentially, we're aiming to be that steady Eddie in a client portfolio. What I'm going to do is I'm going to talk about the two sources of returns that we generate for our investors. The first is the assets that we purchase around the world. I'm going to show you two pie charts on the screen. What we do is we go find discounted assets all over the world, and we make sure that we diversify, and we don't just buy assets in equities, but we buy assets across all the bases. So we'll always have, you know, a bit of listed equity here. Then we'll have some listed debt, maybe some private equity, hedge funds, real estate, and Miles will talk a little bit later. We actually own some aircraft at the moment, but that's another story. By going around the world and purchasing these assets at a discount, we also end up holding a basket of currencies. And our whole philosophy with currencies is to largely reflect the global investable universe. So we're not taking any views on currency, we're just trying to diversify the risk profile. So we'll have a large US dollar exposure. Obviously, the US dollar is a huge part of the global investable universe, talking specifically about developed market currencies. We'll then have some euros. We have a large Australian dollar exposure, and then we'll have other developed market currencies like sterling. The reason we have the high Aussie dollar exposure is for an Australian dollar-denominated company like GVF, the lowest risk currency for us to hold is the Australian dollar. So if we pick up any assets in a currency that we're not so comfortable with, such as rubles, or indeed the China, not that we own actually much Russian stuff at the moment, but if we picked up, say, Chinese equity, we would hedge the currency back into the Australian dollar. So when you look at those two pie charts, what you end up with is a very diversified, unique, but conservative portfolio. I want to drive home that point in this following attribution chart. So what I've done here is, in a graph, I've put from our IPO in 2014 through to basically end of last year, I've attributed out what those two pie charts have achieved. So that is what the assets that we've purchased around the world have done for us. Not too much. That is what the currencies that we've held through time have done. And as you would expect, a largely diversified pool of assets creates a low-risk basket of assets, and that returns a low return. And that, over our lifetime since 2014, has produced about 6% per annum. The way that we outperform and the way that we achieve that 11.1% net of all fees is we strap on top all of the discounts that we purchase those assets at. And that is how we top up the returns to that much higher level. This top navy line shows GVF's net after all fees and costs, net returns, and hopefully illustrates that real market outperformance that we've delivered through time. As I mentioned, GVF, since our launch in 2014 through to the end of February this year, we have managed to achieve 11.1% per annum for our shareholders, and we've done that with an average of 30 to 40% exposure to global equity markets. So a much lower risk profile, but we've still managed to keep up with those global equity returns. Now, probably the most important part of what we do is we aim to pay out all of our investment returns back to shareholders as franked dividends. Now, this slide illustrates all the dividends and franking that we've paid out since our IPO, and hopefully illustrates to you that consistency and reliability of the 8 to 9 cent grossed up dividend stream that we've paid out now for 5 years. So on the initial $1 that was invested at IPO, GVF has actually paid back 56 cents on that $1. And in addition, we have a profits reserve of 26 cents per share, which means that no matter what happens over the next 4 years, we have the ability to pay dividends from our quarantined profit reserve. One more graph, if you'll indulge me, before we get onto the interesting stuff with Miles. And this is my favorite graph. This is a graph that shows every single trade that GVF has ever done during its lifetime, from IPO through to February. And it shows the profit on the left-hand side or losses on the right-hand side of every single one of those trades. What I love about this graph is it has, we're all expecting a huge tail on the right-hand side, but it's actually not the case. And I think that's the thing that I love most. It's really easy to go to the pub and talk about the returns that your portfolio has generated. What's not easy to do is to quantify the risk that you took in order to generate those returns. I'm hoping that what this graph does is illustrate to you the risk that we took in order to generate the 11.1% per annum that we've achieved since our IPO.